we're going to be talking about other current liabilities. So we do have long-term liabilities that can last for many years. However, if a certain portion of those long-term liabilities are going to be paid in the current year, we have to reclassify them as current portion of long-term debt. So they would not appear in the long-term liability section, but that certain portion of that long-term debt that's going to be paid this year needs to be moved to the current liability section of the balance sheet. So if you look at our timeline here, we borrowed $20,000 on May the 1st, and before the year is over, our fiscal year is over, we're going to be paying $5,000 in principal plus any interest. So the current portion of that long-term debt, the $5,000, needs to be reclassified from long-term debt into current portion of long-term debt, which is a current liability on the balance sheet. So to do that, we would debit our note payable for $5,000 and credit our note payable short-term for $5,000. So that decreases our long-term debt by $5,000 and increases our short-term or current debt by $5,000. Now, in later years, you could do the same process and then pay it off, but you will often see that once the payment is made, they simply debit the long-term note payable and credit cash. And if you look at this, what has happened is you've cut two journal entries down into one. So instead of making the reclassification again and then paying cash and debiting the note payable short term, we're just simply taking it out of the long-term portion, leaving that $5,000 in the short-term note payable and crediting our cash. So we're just doing one entry as opposed to two in future years. Accrued liabilities are expenses that have been incurred but not yet paid. So some examples of this would be salaries payable, interest payable, utilities payable, and taxes payable. So let's look at an example here of a liability called unearned revenues. Now, oftentimes, new students of accounting look at this terminology and they say, well, it's a revenue, but it's an unearned revenue. So it is something that you anticipate earning in the future, but you haven't earned it yet, and you've already received the cash for it. So it's kind of something you owe someone. You owe someone either a product or a service that they have already paid you for. So you owe someone something, making it a liability. So here we have Transworld Publishing. They completed the following transactions during 2008. And we're going to journalize these transactions. So on October the 1st, they sold a 6-month subscription and they collected cash of $200 plus sales tax of 9%. So we need to journalize this. So we received cash, but we don't really know how much yet until we calculate it. It wasn't just $200, because if you look at the problem, we also collected sales tax of 9%. But one thing we do know is that we have unearned sales revenue of $200. We owe these customers these 6-month subscriptions. And we know that we're collecting sales tax that we're going to have to send in to the state. So that sales tax is a liability. So I have to credit my sales tax payable. We have to calculate the amount of tax that we collected. And the problem tells us we collected 9%. So $200 times 9% sales tax means we're going to collect $18 in sales tax. So we're going to credit sales tax payable for $18, bringing the total cash collected to $218. Then on November the 15th, we sent that sales tax in to the state of Tennessee. So Sales tax payable, we've got to take it out of that liability account. So to get rid of that, we have to debit the liability. So we're going to debit sales tax payable for $18, and we're sending cash, so we'll credit our cash account for $18. And then on December 31st, the end of the year, we made the necessary adjustment at year end to record the amount of sales revenue that we've earned during the year. So we have to figure out how much we've earned here. So we sold a 6-month subscription on October the 1st. So October, November, December, 3 months have passed. So 3 out of 6 of those months have passed, times the $200. So we basically have collected half of what we received. So to do that, to record that, we need to debit unearned sales revenue for $100 and credit our sales revenue for $100, because now we've earned half of what we received in total. So now what is the balance in the liability account? And the liability account we're referring to here is the unearned sales revenue. So if we draw us a little T account here for unearned service revenue, remember this is a liability, so it's going to carry a credit balance. So we started with $200. So we collected that cash, but we hadn't earned it yet. And now we've actually earned $100 of that at the end of the year. So we still have $100 left that we need to earn.